Imagine that it is October of 1930. You are not a speculator. You are not a Wall Street operator. You are not trying to outsmart anyone. You are a grain farmer in rural Nebraska. You have worked the same land for 3 decades. You know the soil, the weather, the price of seed, the cost of winter, and the feeling of putting a whole year of labor into a harvest that must carry your family until spring. You sell that harvest and put the proceeds into the local bank, because that is what responsible people do. You do not put the money under a mattress. You do not gamble with it. You do not buy some fashionable stock because somebody told you it was going to make you rich. You deposit it in a bank with a solid building, a vault, and the appearance of safety. Then one morning you drive into town to withdraw a modest amount for supplies. There is a line outside the bank. The line is not moving. People are whispering first, then they are arguing, then some of them are shouting. You push forward and see the sign taped to the glass, closed until further notice. You knock. A clerk inside looks at you, then looks away. He does not open the door. The money is inside the building. You can almost imagine it sitting behind the wall of steel. You can see the structure that made you believe the money was safe, but you cannot reach it. And in the world of 1930, you may never reach it again. That is the kind of moment people study as history after it happens. But almost no one understands before it happens. And the lesson is not that 1930 will repeat exactly. History almost never repeats exactly. It rhymes through mechanisms. The reason this matters now is that many of the mechanisms that made that period so dangerous were never truly eliminated. They were renamed, regulated, insured, backstopped, and explained with more modern language. But underneath the language, the basic architecture is still recognizable. When you put money into a bank, you are not placing your money in a storage box. You are lending money to an institution. That is a very different thing. Most people do not think in those terms because the system is designed to feel simple. You log into your account, you see a balance, you swipe a card, you move funds, you receive a statement. Everything feels like ownership because access is smooth, but access is not the same as ownership. Ownership is what you have when the asset cannot be transformed into somebody else's balance sheet without your understanding. Access is what you have until a counterparty cannot or will not give you what it owes. That distinction is small during normal times and enormous during a crisis. Once you understand that distinction, you begin to see banking differently. A bank is not a vault. It is a counterparty. A bank is a leveraged financial institution that borrows short and lends long. It promises daily liquidity to depositors while owning assets that may not be liquid at full value when everyone wants cash at the same time. That is not an accusation. It is the design. A good system can operate this way for a very long time. It can serve commerce, create credit, finance businesses, and make an economy grow. But every system has a machine underneath it, and machines have stress points. The stress point in banking is confidence. When confidence is present, the machine seems almost magical. Depositors do not withdraw everything at once. Loans perform, interest flows, regulators monitor, central banks provide liquidity. Balance sheets look stable when confidence breaks. The same machine becomes fragile very quickly. This was the central lesson of the early 1930s. Most people remember the Great Depression as a stock market crash. They remember Black Tuesday. They remember pictures of men standing outside brokerage houses. They remember the market falling, but the deeper damage did not come only from stock prices. It came from banks. At that time, there were thousands and thousands of commercial banks across the United States. Many were small, local, and tightly connected to the towns they served. They operated under fractional reserve banking. That phrase sounds technical, but the principle is simple. If you deposit $1, the bank does not keep your entire dollar in a vault. It keeps a fraction and lends out the rest. The borrower then spends or deposits that money somewhere else. Another bank keeps a fraction and lends out the rest. The system multiplies money through credit. This is how modern banking works. It is not inherently bad. It is how credit expands, businesses grow, homes are financed, and economies develop. But the same structure creates a fundamental mismatch. Deposits are short-term. People expect to access them whenever they want. Loans are long-term. A bank cannot demand that every borrower repay instantly just because depositors are lining up at the door. So the bank has a short-term liability and a long-term asset. That is the structural tension. In calm periods, the tension is hidden. In panic periods, it becomes everything. In 1930, panic did not begin everywhere at once. It began in places, then spread. A major bank failed. Rumors traveled. People saw what happened in one town and asked whether their bank might be next. That question alone was enough to change behavior. A bank run is one of the clearest examples of how human psychology and financial structure combine. If one person withdraws, nothing happens. If 10 people withdraw, probably nothing happens. If everyone decides to withdraw because everyone else might withdraw, then the bank fails because the money is not there. In the form people imagine it is there. The system turns belief into reality. If enough people believe the bank is safe, it can remain safe. If enough people believe it is unsafe, that belief can make it unsafe. Between 1930 and 1933. Thousands of American banks closed, deposits were destroyed. People who had done what society told them to do lost money they believed was secure. They did not lose it because they bought bad stocks. They did not lose it because they speculated. They lost it because they trusted an institution without understanding the contract. That is the first principle I would want anyone to understand. Do not confuse a working system with a riskless system. A system can work most of the time and still fail under certain conditions. That is true in markets, it is true in politics, it is true in empires, it is true in banking. After the damage of that period, the United States created deposit insurance. The FDIC was designed to restore confidence by telling depositors that within a certain limit, the government would stand behind their balances if a bank failed. That changed behavior, it reduced panic, it made the banking system more stable than it had been before. But it did not make all bank deposits perfectly safe under all possible conditions. That is where many people make the mistake. They hear the words deposit insurance and translate them into unlimited safety. Those are not the same. Deposit insurance has limits. It covers insured deposits up to the applicable amount. It is designed to handle failures that are isolated and manageable. One bank fails. Regulators step in. Insured deposits are protected. The problem is contained. That is very different from a systemic crisis in which many institutions face stress at the same time. In that scenario, the issue is not whether an insurance program exists. The issue is whether the size of the losses overwhelms the size of the fund, how fast the government responds, whether emergency authority is used, and whether the political system chooses to make depositors whole. When Silicon Valley Bank collapsed in 2023, many deposits exceeded the normal insurance limit. The government made a decision to protect all depositors because regulators feared contagion. That decision may have prevented a larger panic, but it was discretionary. It depended on circumstances, judgment, and systemic risk. That is not the same as a permanent legal guarantee for every depositor in every circumstance. I am not saying that to scare anyone. I am saying it because good decisions require understanding what the system is and what it is not. When a government steps in during a crisis, it is not usually because every claim is naturally safe. It is because policymakers are trying to prevent the crisis from spreading. That is a different kind of protection. It is protection based on the needs of the system, not always the needs of the individual. This is why the concept of a bail-in matters. Most people know the word bailout. In a bailout, outside support, often from the government or central bank, is used to stabilize a failing institution. The public sees it. The politics are ugly. People get angry because taxpayers appear to be rescuing financial institutions. After 2008, regulators around the world began to prefer another model. Instead of always asking taxpayers to absorb losses, losses could be imposed inside the institution itself. Shareholders first, then bondholders, then in some frameworks and under some conditions, large uninsured depositors or creditors. That is a bail in the bank is stabilized by converting or reducing claims against it. The important point is not that every depositor will be hit in every crisis. That is not how these mechanisms work. The important point is that the legal architecture exists because modern regulators know that large financial institutions can fail, and they have built procedures for distributing losses when they do. The example that made this very real was Cyprus in 2013 during the Cypriot banking crisis. Uninsured depositors at major banks took major losses. Some deposits were converted into bank equity, capital controls were imposed, withdrawals were restricted. People discovered that a bank balance could be visible on paper and still not be fully accessible. That is an important distinction. A financial claim can exist and still be trapped. A deposit can be recorded and still be subject to limits, delays, conversion, haircut, or political decision. Again, the lesson is not that every country becomes Cyprus. The lesson is that under stress, governments and regulators prioritize system survival. That is rational from their point of view. If you are responsible for the whole system, you try to keep the whole system functioning. But what is rational for the system can be painful for individuals who assume they had perfect control over their money. This is why I think in terms of mechanisms and probabilities, not slogans. The slogan says, "My money is safe in the bank." The mechanism says, "My deposit is a claim on a bank, protected up to certain limits by insurance, subject to laws, liquidity conditions, and resolution frameworks." Those two sentences produce very different behavior. One produces complacency. The other produces preparation. Preparation does not mean panic. It means understanding where each part of your liquidity sits, what risks it carries, and what it is supposed to do. Cash outside the banking system is one form of liquidity. It is old, simple, and direct. It cannot be frozen by a bank run because it is not in a bank. It cannot be converted into a bank's equity because it is not a bank liability. It has immediate usefulness in some kinds of disruptions. But physical cash has its own risks. It can be stolen, it can be destroyed, it earns nothing, and over long periods inflation eats it in a deflationary depression. Cash can become very powerful because prices fall and purchasing power rises. In an inflationary breakdown, paper cash can lose value rapidly. So cash is not simply good or bad, it depends on the environment. That is how I look at all assets. Every asset solves one problem and creates another. Treasury securities solve a different problem. A treasury bill or note is a direct claim on the government rather than on a private bank. In a dollar-based system, treasuries are the core collateral of the financial world. They are generally considered the safest dollar-denominated asset. But they too have trade-offs. If you hold them through a brokerage, you introduce brokerage and custody procedures. If the broker fails, protections may exist, but process matters. Assets can be frozen while records are reconciled. If you hold them directly through the government, you reduce one kind of intermediary risk, but may give up some convenience and speed. There is no free lunch. Money market funds are another common place people treat as cash. They invest in short-term, high-quality instruments and are designed to be stable. But they are securities, not bank deposits. In normal conditions, they can be useful cash equivalents. In stressed conditions, they can face redemption pressure. We saw this kind of stress in 2008 when a major money market fund broke the buck. The government intervened to stabilize the system, but the lesson was clear. Even instruments that feel like cash are not always the same as cash. Gold and precious metals sit outside the credit system in a different way. Physical gold has no counterparty risk in the same sense a deposit does. It cannot default. It cannot be printed by a central bank. It has held value across long periods of monetary disorder. But gold has its own problems. It produces no income. It can be volatile. It must be stored. If stored in a bank safe deposit box, it may not be accessible during a bank holiday. If stored privately, security becomes your responsibility. And history shows that governments can restrict private ownership of gold when they believe national monetary policy requires it. That happened in the United States in 1933. So gold is not perfect. It is a tool with strengths and weaknesses. Foreign currencies and foreign accounts provide another form of diversification. A person can reduce exposure to one banking system or one currency by holding assets in another jurisdiction. That can make sense structurally when done legally and transparently. But it introduces currency risk, reporting requirements, foreign laws, and complexity. For Americans, foreign accounts above certain thresholds carry serious reporting obligations. Failure to comply can be costly. So offshore or foreign diversification is not something to treat casually. It is legal when done correctly. It is dangerous when done carelessly. Real assets are different. Again, land, property, productive assets, and useful commodities are not bank liabilities. They cannot be bailed in. They exist in the physical world and can have utility beyond financial pricing. But they are not liquid. You cannot pay tomorrow's emergency expense with a farm unless you can borrow against it or sell part of it. In deflationary crises, real assets can fall because buyers disappear and credit contracts. In inflationary periods, they may protect purchasing power better than cash. Again, the principle is the same. Every form of safety is conditional. The person who says one asset is always safe has not studied enough history. The person who says all assets are unsafe and therefore nothing can be done has not thought clearly enough. A resilient approach comes from balancing risks that fail in different ways. You do not prepare for uncertainty by betting everything on one prediction. You prepare by making sure that no single failure mode destroys you. That is how systems thinking works. A good bridge is not designed only for average traffic. It is designed for stress. A good portfolio and liquidity plan must be the same. It must work not only when the bank app opens, transfers settle, markets are calm, and regulators are quiet. It must still have options when one of those things is not true. This is where most people fail. They optimize for convenience in good times and discover fragility in bad times. The banking system encourages that it is easy to keep everything in one place. It is easy to let automation create the feeling of safety. It is easy to believe that because something has never failed for you personally, it cannot fail. But history punishes that kind of thinking. The farmer in Nebraska did not think he was making a risky decision. He was doing the normal thing. The people in Cyprus did not think they were making a risky decision. They were using banks. The depositors at failed institutions in modern crises often believed regulation had removed the danger. The problem is that systems often appear strongest right before they reveal their weakness. That is not because people are stupid. It is because incentives hide fragility until stress exposes it. In banking, fragility can be hidden by rising asset prices, low interest rates, stable deposits, and faith in policy support. Then the environment changes. Interest rates rise, long-duration assets fall in value. Depositors move money. Banks that seem stable suddenly have unrealized losses that matter. If they can hold assets to maturity, maybe the accounting looks manageable. If depositors force them to sell, losses become real. That was one of the lessons of the regional banking stress in 2023. A bank can hold securities that appear safe from a credit point of view, but dangerous from an interest rate point of view. If rates rise sharply, the market value of those securities falls. If depositors leave quickly, the bank may have to sell at a loss. The loss damages confidence. The damaged confidence accelerates withdrawals. The withdrawals create more forced selling. That is how a balance sheet issue becomes a bank run. And in the digital age, bank runs do not move at the speed of people standing in line outside a building. They move at the speed of smartphones, group chats, corporate treasurers, and online transfers. The old bank run was physical. The modern bank run can be instantaneous. That changes the speed of crisis management. Regulators must move faster. Central banks must react faster. Depositors can panic faster, but the underlying mechanism is old. Short-term claims, long-term assets. Confidence as the load-bearing wall. This is why I would not begin by asking, is my bank safe? I would ask better questions. How much of my liquidity depends on one institution? How much is above insured limits? How fast would I need access in a disruption? What portion of my cash is needed for monthly expenses, emergency expenses, taxes, payroll, or family obligations? What happens if an account is frozen for 3 days, 2 weeks, or longer? What happens if a bank fails on Friday and access is uncertain until Monday or beyond? What happens if a transfer system is delayed? What happens if a currency weakens? What happens if inflation remains high? What happens if rates stay elevated and bank balance sheets remain under pressure? These are not predictions. They are stress tests. The goal is not to forecast the exact crisis. The goal is to avoid being fragile in many possible crises. That is the difference between prediction and preparation. Prediction says, I know what will happen. Preparation says, I do not know exactly what will happen. So I will structure my life so I can survive multiple outcomes. That is the correct mindset. The banking system is not evil. It is a machine. It creates credit and liquidity and economic growth. It also creates leverage and maturity mismatch. If you understand both sides, you can use the machine without worshiping it. The mistake is treating the bank as if it were outside the laws of risk. No institution is outside the laws of risk. Not banks, not governments, not currencies, not central banks, not markets. Everything is part of a system of claims, obligations, incentives, and confidence. When confidence is high, claims feel like money. When confidence breaks, people discover which claims are money and which claims are promises. That discovery can be very painful. The way to reduce that pain is not to withdraw from the modern world. That is not realistic for most people. The way is to understand layers. One layer for everyday operating cash. One layer for insured deposits. One layer for short-term government obligations. One layer for assets outside the banking system. One layer for long-term purchasing power. One layer for productive assets. One layer for emergency optionality. The exact allocation depends on a person's circumstances, country taxes, legal obligations, age, and goals. That is why I do not make a universal prescription. But the principle is universal. Do not let one system hold all your options. The people who survive financial disorder usually are not the people who forecast the headline correctly. They are the people who remain liquid enough, diversified enough, and calm enough to make decisions while others are forced to react. In 1929, the tragedy was not only that banks failed, it was that people learned what a bank deposit really was after the doors were locked. That is the most expensive time to learn in Cyprus. Many learned the meaning of uninsured deposit only after the haircut was imposed. That is the most expensive time to learn in Argentina. People learned the meaning of capital controls only after accounts were frozen. That is the most expensive time to learn in modern banking stress. People learned that insured limits, systemic exceptions, emergency facilities, and political decisions are not the same thing as simple access to money. Again, that is the most expensive time to learn. A good principle is to study the autopsy before you become the case. Look at where systems failed before. Look at who paid. Look at which assumptions proved false. Look at what kinds of assets remained accessible and what kinds became trapped. Then build from that. The recurring pattern is that the uninformed carry more risk than they realize. They are told the system is safe, and in ordinary conditions that is mostly true, but they are not told the conditions under which the system becomes unsafe. That missing knowledge is the risk. The architecture of money has changed in name, but not in essence. Deposit insurance is confidence management. Bail, in rules, or loss allocation. Emergency lending facilities are system stabilization. Capital controls are flow management. Monetary expansion is crisis financing. These are not conspiracy terms. They are tools. The question is who benefits from the tool, who pays for the tool, and under what conditions the tool is used. Once you think that way, you become much harder to fool. You stop asking whether the building looks safe and start asking how the liabilities rank. You stop asking whether your account balance appears on a screen and start asking who owes it to you. You stop asking whether a guarantee exists and start asking the size, limit, timing, and conditions of that guarantee. You stop asking whether a crisis will happen next week and start asking whether your structure would survive if one did. That is the mental shift. Most people do not need extreme actions. They need clear thinking. They need to know where their money is, what legal form it takes, what institution stands between them and access, and what happens if that institution is stressed. The better you understand the map, the less you panic when the terrain changes. This is also why central bank policy matters so much. The modern banking system is tied to interest rates. If rates stay high because inflation persists, banks holding long-duration assets remain under pressure. If rates are cut aggressively to relieve that pressure, inflation and currency weakness may reappear. That creates a difficult policy trade-off. There is no painless path when too much debt and too much duration risk have built up over time. One path protects bank balance sheets but may punish savers through inflation. Another path protects currency value but may keep pressure on leveraged institutions. The system can manage those trade-offs for a while. It may manage them well, but they are real trade-offs. When you see them, you stop being surprised by sudden interventions. You understand why emergency lending facilities appear. You understand why governments may guarantee deposits beyond formal limits in one case but hesitate in another. You understand why regulators talk about stability, confidence, contagion, and systemic risk. Those words are not abstract. They are the language of a system trying to maintain belief. And belief is the foundation of modern money. That does not mean the system is doomed. It means the system must be understood. Fear says the banks will fail, run now. Complacency says nothing can happen, relax. Principled thinking says banks are useful counterparties, but counterparties carry risk, so structure your life accordingly. That is the position I think is most rational. You do not have to predict the next 1929, the next 2008, or the next 2023 to learn from them. You only have to understand that the same broad pattern has appeared again and again. Confidence builds, leverage expands, risk becomes hidden. People forget history. A shock arrives, liquidity disappears, authorities intervene. Losses are distributed. The public learns the rules after the fact, then the cycle begins again, with new language and better technology. That is how financial history works. The people who do best are not necessarily the most pessimistic. They are the most prepared. They do not live in fear. They live with respect for risk. Respect for risk means holding enough liquidity to avoid forced selling. It means not placing all cash above insured limits at one institution. It means understanding that a bank deposit is a claim, not a magic box. It means knowing that insurance limits matter. It means knowing that political decisions can help you but should not be your only plan. It means understanding that assets outside the banking system may solve some problems while creating others. It means documenting accounts, beneficiaries, access procedures, and legal obligations so that a temporary disruption does not become a permanent disaster. It means talking to qualified professionals before moving money in ways that create tax, legal, or reporting problems. Most of all, it means not waiting until the doors are locked, because the worst moment to build a plan is the moment everyone else needs the same exit, when everyone wants out at the same time. Not everyone can get out. That is the one sentence that describes most banking crises. It was true in the early 1930s. It was true in Cyprus. It was true in capital control episodes. It was true when digital withdrawals accelerated modern bank runs. The forms change, the principle remains. I would rather understand a hard truth early than be comforted by a soft illusion late. The hard truth is that money in a bank is not stored money. It is a relationship. It is a credit relationship. The bank owes you. And when a financial relationship depends on the solvency and liquidity of the party that owes you, you have counterparty risk. That does not mean you avoid banks. It means you do not misunderstand them. The purpose of studying 1929 is not nostalgia. It is not doom. It is not to say that the modern system is identical to the old one. The purpose is to see the mechanism under the story. A farmer deposits the proceeds of a year's work. A bank lends and invests, confidence breaks. Withdrawals exceed available cash. Doors close. Claims become uncertain. The person who thought he had money discovers he had a promise. Modern versions have better tools, better regulators, better insurance, and faster central banks. They also have larger balance sheets, faster communications, more complex derivatives, more interconnected institutions, and political constraints. That makes the system stronger in some ways and more fragile in others. The intelligent response is not panic. It is humility. A humble investor or saver says, I do not know the exact future, but I know systems have failure modes. I know promises can become conditional. I know liquidity matters most when it disappears. I know diversification is not about maximizing return. Sometimes it is about preserving choice. Choice is what matters in a crisis if you have only one form of money in one institution, in one jurisdiction. Your choices are narrow if you have layers: documentation, liquidity, and knowledge. Your choices are wider. That is the practical lesson. In ordinary times, the difference may seem unnecessary. In stress, the difference can be everything. The person with options can wait, move, negotiate, rebalance, and survive. The person without options must accept whatever terms the crisis imposes. This is why I spend so much time studying cycles, not because history gives us exact dates, but because history shows us repeated pressures in human behavior and financial systems. People overtrust during stability. They underprepare during expansion. They chase yield when cash feels boring. They concentrate when diversification feels unnecessary. They ignore legal structure when access feels effortless. Then the cycle turns, and the old questions return. Who owns what? Who owes whom? Who is first in line? Who is last? Who can access liquidity? Who must wait? Who can move before controls? Who is trapped after controls? Who prepared for uncertainty rather than betting on a single story? Those are the questions that matter. If you can answer them before a crisis, you are not guaranteed safety, but you are far better positioned than the person who cannot answer them at all. Let me bring this back to the most important point. The banking system depends on confidence, but your financial life should not depend only on confidence. Confidence is good when it is justified. Blind confidence is dangerous. The right posture is informed confidence. You use the system, you respect the system, you benefit from the system. But you know what the system is? A bank is not a vault. A deposit is not a physical stack of bills waiting for you. Insurance is not unlimited. Liquidity is not guaranteed under every condition. Government intervention is not always automatic, and safety is not a feeling. Safety is a structure. That is the principle I would build around. If you want to protect money, first understand the legal form of the money. Is it a deposit, a security, a treasury obligation, a physical asset, a foreign currency, a claim on a fund, a claim on a broker, a claim on a bank? Then understand the failure mode. Can it be frozen? Can it be inflated away? Can it be stolen? Can it be bailed in? Can it be delayed? Can it be confiscated? Can it become illiquid? Can it fall in market price when you need it? Can it create tax or reporting problems? Only after that should you ask what role it plays. That is how a principled financial system is built at the personal level, not by chasing fear, not by trusting slogans, by matching assets to risks. The lesson of 1929 is not that everyone should keep everything in cash. That would be too simple and wrong in many environments. The lesson is that promises can fail. The lesson of inflationary collapses is not that cash is always king. It is that currency itself can be the thing failing. The lesson of Cyprus is not that every bank deposit will be haircut. It is that uninsured claims can be part of loss distribution. The lesson of 2023 is not that every regional bank is unsafe. It is that interest, rate risk, and deposit flight can turn a stable-looking balance sheet into a crisis very quickly. Each lesson covers a different failure mode. The wise person studies all of them. Then they build a structure that can bend without breaking. That is how you preserve wealth through cycles. Not by assuming the world will be calm, not by assuming the world will collapse, by being prepared for a range of outcomes and refusing to let any single institution, currency, or assumption become the point of failure for your life. The farmer in Nebraska did not lose money because he lacked character. He lost money because he trusted a system he did not understand. That is the tragedy. And it is also the warning. You can be honest, hardworking, careful, and still be harmed by a financial structure if you do not know how that structure works. That is why learning the mechanics matters. When you understand the mechanics, you stop being passive, you can ask better questions, you can reduce concentration, you can plan liquidity, you can respect insurance limits, you can separate emergency money from long-term money, you can prepare documentation, you can avoid depending on one exit. And perhaps most important, you can remain calm when others are surprised. Calm is a competitive advantage in financial crises. But calm does not come from ignorance. It comes from preparation. The next crisis may not look like 1929. It may not look like Cyprus. It may not look like Silicon Valley Bank. It may come from interest rates, currency pressure, government debt, a regional banking problem, a cyber failure, capital controls, inflation, deflation, or something none of us can name today. The source will change. The mechanism will probably look familiar. Too many claims. Not enough immediate liquidity, a break in confidence, a policy response, a distribution of losses, a public that learns the rules late. That is why you study the old crises, not to predict the next headline, to understand the machine before it is under stress. Most people wait until the sign is on the door closed until further notice. By then, the learning is no longer educational, it is personal. I prefer to learn earlier. I prefer to know where my money actually is. Who owes it? What law governs it? What limit protects it? What risk threatens it? And what alternatives exist if one path closes? That is not paranoia. That is prudence. And in a world of debt cycles, monetary expansion, interest rate shocks, and increasingly fast financial panic, prudence is not optional. It is the price of staying in control. So do not ask whether you should trust banks or distrust banks. Ask whether you understand banks. Ask whether your structure assumes perfect conditions. Ask whether your liquidity plan has more than one layer. Ask whether your family would know what to do if access were interrupted. Ask whether your deposits are within insured limits. Ask whether your emergency cash is truly accessible. Ask whether your long-term purchasing power is protected from inflation. Ask whether your assets are diversified across institutions, instruments, and risk types. And ask all of that before the crowd starts asking it. Because once the crowd asks together, the exit narrows. That is the old lesson. That is the modern lesson. The words change, the laws change, the technology changes. But the core principle does not change. When confidence breaks, the system protects itself first. Your job is to structure your life so that when that happens, you still have choices.